What's happening, people? Great to see you. Welcome back. My name is Killian, and today we're going to be running through 3 of the biggest mistakes I've made in my first 6 months trading on Trading 212, and giving you some real-world examples that have actually cost me. I'm also going to finish up with some actionable steps that will hopefully help you avoid the pitfalls. If you're new to the channel and you enjoyed this video, please consider giving that like button a slap and subscribing below. We're trying to get to 400 by the end of the month. Now, to not waste any more of your time, let's get into the video. Mistake number 1 is trading blind. In essence, not doing adequate research. This would include only getting your information from one source or only looking at bullish reports on a specific stock. And something I think is becoming even more prevalent now is just blindly following someone that you see on the internet. So that could be on YouTube or someone that writes an article. Now, these people are right a lot of the time. And I would say that if it's someone you've been following a long time, they have a good track record and you can trust them, that they are a good bet from time to time. However, unfortunately, they're not always going to be right. I have a perfect example of this. So when I was first getting into investing, EV was booming. It still is to an extent, but at this time there was a SPAC called Tortoise Acquisition Corp that was merging with Hyliion, and it was absolutely hyped to the moon. Hyliion is a manufacturer of electrified powertrains. Jeez, that's hard to say. At the time, you would have seen tens of videos being uploaded about how far this stock was going to go after the merger. I actually bought in at $40 a share, bought even more at $52 a share, and if you can believe it, I bought even more on the way back down at $44 a share. I just got so caught up in the hype train. Well, after the merger, let's just say, things didn't go quite as planned. In total, I spent €461 on shares of Hyliion, and sold those same shares for €204. Over 50% of my investment lost on one company. And while these may sound like small numbers to you, at the time I was just getting started, so this was a big loss. So what did I learn? 1 is that the stocks don't only go up. 2 is that people on YouTube can be wrong, or people on the internet will be wrong. And number 3 is to research the stocks yourself. If I had, there's still a chance I would have invested the same amount or even invested more, but at least I could have justified my investment. To this day, I couldn't tell you what differentiates Hyliion in the market. Whether they have a positive financial forecast, a robust list of pre-orders, or even any useful partnerships. I invested in a company based on hype, knowing nothing about that company, in the hopes of making money. Please learn from my mistake. Hyliion isn't the only example of this for me, and I'm positive you'll also get caught in the same trap. It's just so easy to get caught up in the hype and see your portfolio as a game. But at the end of the day, this is your hard-earned money, and you should be careful with where you put it. Take your time to actually do some financial analysis or technical analysis. And to be honest, the most important one to me is just to research the company themselves and see if they align with your goals. The second mistake I made was trading without a strategy. So when I say strategy, I mean, what type of investor are you? What's your risk tolerance? How do you plan to build your portfolio? There seems to be, at face value, infinite ways for you to play the market. Whether you want to be a swing trader constantly on your trading app looking for potential swings, or you want to be a long-term investor. So you want to put your money in, not look at it for years and see it accumulate sometime down the line. As well as this, what's your risk tolerance? So I can't answer any of these questions. You need to consider this for yourself. But what I can tell you is I wish I asked myself this sooner. In the beginning, I did what I'm sure so many others do. I invested in the companies I knew about. So your Amazons, your Apples, your Google, the big boys, or the Fang Gang, as some people like to call them. Nobody calls them the Fang Gang. This was okay, and I did see some percentage returns, but I found myself yearning for more. This is when I decided on my strategy. A mix of long-term investments which have a lower risk versus reward ratio, coupled with some speculative investments on a variety of penny stocks and SPACs. I wanted to see a greater return on my investment in a shorter period of time, and I did accept that there was a chance that I could lose a lot more money if I didn't pick the right companies. I also didn't quite grasp at the start that you should sell at some point. I thought everything would continue flying up to the moon and never come back down. But as you know, stonks don't just go up. This is where a strategy is important. If it's a company that I don't see as a very long-term hold, and I get a 50% or 100% to the upside very quickly, it might be worth my while to take some profits, whether that be just a percentage or the whole investment. That's really going to depend on the company itself. There is nothing wrong with taking profits, and it's something I didn't do at all at the start. That's not to say you should never hold either though. You're never gonna 100% know which way the stock is going to go. You just need to make a call in that moment. A perfect example of this is I was heavily invested in Workhorse at $23 a share. In September, it got all the way to $31 a share on very little news. They were waiting on a contract, but there was no specific date yet. And I thought, well, I should sell here. This looks like it's near the top. I didn't sell, and it came back down to $15 a share. Now obviously Workhorse is way up again now, so that worked out okay in the end. Something else to consider is diversification. So I think I started out at like 10% FANG and 90% EV. But then what would happen is if EV had a bad day, my portfolio was a mess. You need to diversify your risk really. And I've since added some companies in various industries. Now I am still very exposed to EV, but that's because it's an industry I believe in and I can justify it to myself. And the third mistake was trading without a specified budget. So right off the bat, you need to understand that investing can be addictive and not everyone's gonna win. That's proven by my earlier story about Hyliion. When I first got into the market, I had quite a few green days. One too many maybe. And I just thought, you know what? All W's from me, baby. Why not keep going? Then I ended up overextending on the specified resources I had for investing at that time. I hadn't specified my exact amount of capital to be invested. And seeing all these green days, I thought, feck it, why not throw some more money at it? Thankfully, I wasn't incredibly stupid and I only invested what I could afford to lose. But that does bring me back to one of the key tenets for investing for me. Only invest what you can afford to lose. Since then, I have a much more rigid investment structure that I at least try to keep to. I would suggest setting a specific percentage of your monthly income and adding that to your trading account. Now what that percentage will be will obviously vary from person to person. But don't just rush into investments on the first of the month either. It's good to have cash on hand in case there's good opportunities. So those are the 3 mistakes I made. Trading blindly, trading without a strategy, and trading without a specified budget. To try and combat this, I would suggest doing your own due diligence research before investing in a stock. How deep you go in this research, that's up to you. Take the time to consider how you want to approach the market. So the time you want to put in, the companies you want to invest in, your risk tolerance, etc. Just consider your strategy. And finally, set a specific proportion of your income you want to invest and do your best not to go over that figure. So thank you very much for taking the time to watch this video. I really do appreciate it. If you enjoyed the video, please give that like button a slap and consider subscribing below. I'll see you in the next one. Good luck.